Hello, fellow investors, and welcome to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Today, I've got a very special guest. His name is Michael Blanc. Michael is a prolific educator and thought leader in the real estate space. He is a best-selling author of Financial Freedom with Real Estate Investing, and he is the host of his own podcast. And he's the partner within Nighthawk Equity, which owns over 300 million in multifamily real estate. And even in addition to that, he's educated so many people in this space that he's helped people buy over 40,000 units valued at over 1.5 billion. And so, Michael, just incredible value you've brought to the space, and so excited to have you on the show today.
It's great to be here.
Well, Michael, as we dig in today, let's start at the top and let's just help everybody understand a little bit about your story and how you got to be where you are today.
Yeah, I maybe have a similar story to a lot of people. I kind of followed the playbook, go to school, get good grades so you can get a job with benefits, right? So that's what I did. And I got myself a master's in computer science and did a bunch of software stuff. And in 97, I joined a company called Web Methods. And 3.5 years later, in March of 2000, that company went public. And at the time, it was the most successful software IPO of all time. We actually had revenue, unlike so many other .coms. And it made me like a gazillionaire in paper. I say in paper because the day after the NASDAQ collapsed, and so you're locked up for 6 months. And so by the time I was able to sell stuff, it wasn't nearly as much as 6 months prior, but it still put a bunch of money in my pocket. And so that was pretty cool. I really felt like a genius until I read Rich Dad Poor Dad in 2005. And that really threw me for a loop because I had not ever heard of this idea of financial independence and passive income. It really confused me to the point where 3 months later, I came home and quit my job. I came home, my wife said, "Hey, quit my job." She goes, "What the? Like, what's your plan?" I'm like, "Well, I don't have a plan, but I got money. So who needs a plan when you have money?" And so I just really studied how money works. And I took a bunch of courses. I took a commercial real estate class. I actually traded stocks and options for a little while. It was the Iron Condor. It was freaking unbelievably awesome. And but my big idea is I got into the restaurant franchise world and I went all in. Forget diversification. I was like, this is my path. I'm going to buy this territory of high-end pizza joints. And I hired an operator. It was all set up as a passive investment, which it was for about 2.5 years until the recession hit. And then it no longer worked so well. In fact, it worked so poorly that I ended up losing everything in the giant restaurant debacle. I think at the height, I had 8 restaurants, which quickly went from becoming a income-producing asset to a cash-sucking endless pit that I had to fire my operator and finally had to sell those. And it was impossible to sell a money-losing restaurant after the recession, so I basically gave it away. But it took me a long time to do that. Meantime, I needed income. I almost went back to getting a job, but I flipped a couple houses in 2006, which went really well. I was like, all right, I'm going to go back into the flipping business and started using hard money. And we were like 2 houses a month. It was a serious operation. And then in 2011, I kind of accidentally got into an apartment building. It was a 12 unit in DC through one of my wholesalers. And that was a nightmare in itself. That was not pleasant for about 18 months. It was a complete nightmare. I immediately regretted the departure from my core, which was flipping houses and trying to get out of restaurants. However, after that 18 months, the light bulb went off because that thing started sending me $1,500 in mailbox money. I was like, well, wait a minute. The flips are generating chunks of cash, but they're certainly not mailbox money. Why don't I stop doing that and start doing more of the other? And that's kind of when I started pivoting. I started blogging about it on my own site on the Bigger Pockets. I created some software, analysis software, and some courses and started a podcast, wrote a book, and created this community. And that's kind of when deals and money started flowing my way. And I started doing a bunch of joint ventures. And today through Nighthawk, we have about $300 million in real estate. And we have an educational platform to help people really scale with real estate. But it's not with flips and not with rentals, but it's actually with commercial real estate, mostly multifamily. And the people that we work with are able to quit their jobs in 1 to 2 years. And that really lights me up because the whole real estate investing thing has really frustrated me and frustrates a lot of people.
Yeah, I mean, that's an incredible story, Michael. The lessons learned, the twists and turns, and through all that ending up in multifamily, right? Which is the Same path I've ended on, realizing this is the best place I believe to make long-term wealth. And what an amazing value you've provided in that you're teaching all these people how to do it. And so I thought it would be a great little twist today to really extract some of that information from you, right? Like some of the things you've learned from teaching so many people how to invest in real estate and help our listeners, maybe avoid some of those same mistakes or maybe even shift their mindset a little bit, right? And to make them better investors. And so really appreciate you willing to come and share some of your info today. First question as we get started is, as folks come into your classes, what are some of the misconceptions they have or common things that they get wrong about real estate investing?
Yeah, let me start earlier on. There is a variety of people from different levels of experience and awareness that are coming in. Let me start at the kind of lower end. What I mean by lower end, these are people who probably have done a rental or two or flip or two, okay? And they are scratching their head, kind of like you and I have done, like, my gosh, I can't generate enough passive income doing this stuff. Like, the only way I can scale this thing is to work harder, but it doesn't seem to sit well, right? So how do I scale flips? How do I scale rentals? It's a lot of work to scale out of those strategies. And so we really talk to people who are scratching their heads, who understand the benefits of real estate, but they also understand the problem. And that is one of scale. And so the biggest mistake that real estate investors make, like I did, is we don't actually sit down and actually put pen to paper and really make some financial projections. Will I actually achieve my financial goals with flips or with long-term rentals or short-term rentals? What is the risk associated with that? What is the level of work associated with that? And the conversation we have with investors are along those lines. Hey, have you ever thought about that? And the answer is almost always no. I haven't thought about it. I'm just going to do another flip or another because I'm a real estate investor. And surely, if I do this long enough, I will eventually get to what Rich Dad talks about. And of course, they don't. And so the biggest mistake that investors make is they don't really look at their strategy and figure out, is this really going to get them? And they will inevitably, like you and I have, come to the conclusion that no, they can't get there. And so what will they do? And so now they're like, well, gosh, I can do more flips and rentals, but that's not going to work well. I can get into a franchise. I can get into commercial real estate, but that's certainly too advanced. And so they're just confused. They're dazed and confused because of what they think they know about commercial real estate. And this is where you have some false information and some limiting beliefs that get into that. And it's normally, I don't have the experience and I don't have the money. Like if I had another 10 years of experience, that would satisfy that. And all the money I'm going to make the next 10 years, I can now take that money and get into commercial real estate and multifamily. And both of those I'm saying are not only limiting beliefs, but they're false beliefs because neither of them are actually true.
So that's really interesting. Dig into that a little bit more. So, I mean, it seems pretty logical. You say, well, I don't have the money to go do this and I don't have the experience to go do this, so I shouldn't go do this, right? So what do you tell these folks?
So I think the biggest difference in from between single family house investing and scaling is the mindset. And it's the difference between a single family house investing mindset and a scaling mindset. The biggest difference, if I were to boil it down, is who, not how. It's a book by Dan Sullivan. Mm-hmm. And it changes everything. It literally changes everything because you don't really need a who, not how mentality for flips or rentals. You don't. It's you. It's me. Because most people live in a house or an apartment, they can wrap their head around it. Everyone knows how to get MLS. Everybody's got a little bit of money laying around. Everybody knows creative money strategies or whatever, hard money. Okay, so it's not really a stretch to buy a rental or duplex. Okay, and so that's why people do it. It's not really a stretch. And so with a who, not how mentality, what they talk about is if you want to scale anything, okay, including your business, your real estate, your health, relationships, it's a who, not how mentality. And what that means is it's actually freeing because it removes the need for you to do everything yourself, for you to have everything yourself. Who, not how, it says, if I want to know, for example, how do I pick a market? How do I find a deal? How do I raise all this money? It's the wrong question. You're asking how questions. You should be asking who questions. Who can help me get a deal? Who can help me get capital? Who can run this thing? And when you start asking who, not how, it simplifies everything. It removes you entirely from the actual how questions and opens up the world, right? And so that who, not how mentality solves the two other problems. I'll get back to two other. I don't have the experience. Well, you don't need to have the experience. Imagine if you assembled a team of professionals, and let's say you have a property manager on your team and a lender for good measure. Let's say you throw in a CPA or whatever. When you now talk to investors or brokers, they're not going to ask you about your experience because you're already going to talk about the team you've built behind. You got Sam at XYZ Management Company. They manage 5,000 units. You got Bill at XYZ Lending Company. They originated $1 billion of loans last year. No one's going to ask you about your track record because clearly you must be a serious person because you've assembled this team, and this credible team, so therefore you must be so no broker is going to risk insulting you by asking you what your actual apartment investing track record is because of that. Now, if you don't do that, you don't build a team and you don't talk to them about your team, they will ask you about that. And then they're going to ask you for proof of funds, which you don't have. And people slink away going, oh my gosh, I can't get into the end of the deal. So building a team helps you with credibility. It also helps you with money in two ways. Number one, raising money from other people is part of your team. But more importantly, you can raise money through partners. I mean, you have a partner who's focused on raising money, but there's a class of people in our environment. It's actually a 50-50 split between people who are more finding deals, they're deal finders, and more people who are raising capital. And it's not that they know how to raise capital. It's just that their personality is more conducive to raising capital. Now, you got to arm them with a playbook, okay? And now you're like, okay, I got a playbook. I know what to do with that. And so half of people, our students, for example, are capital raisers. And you partner with these capital raisers. So people who don't know how to raise money either don't have the personality for it. They probably shouldn't raise money en masse, okay? Or they don't know how to do it, right? So in our environment, if you are conducive, you go through this fundamentals of how to do a syndication, then we ask you to specialize. So the people who don't have or don't know how to raise the money because they're more deal finders, the solution is, again, to attract to your team a partner who does. And so this who, not how mentality pervades everything in a syndication. And this, to me, makes everything easier. Buying a 20, 50 unit building is actually easier than buying a single family house. It also makes it more enjoyable. So I think fundamentally, learning the who, not how mentality is key for scaling real estate.
And I think that's an amazing insight. I mean, Who Not How is an incredible book. I take a lot of lessons from it as I build out my own team. And I agree, it does make it simpler in that you don't have to figure out every problem yourself, right? There's always people out there that have the knowledge. You just need to find those folks and align yourself with them. And I think that's a great way on how to, like you said, as we started that question, and what people get wrong, right, when they come in. So maybe they're trying to do it themselves. They've got some limiting beliefs. A lot of what I heard, though, what you talked about was people having to get outside of their comfort zone, right? Because no matter what they're doing, it's new. I mean, even if you're investing passively, right, and you've never done it before, and you don't know much about real estate, it's a big leap to take. So how do you help people get outside of their comfort zone, get past the limiting belief? I mean, is there a process you take people through to kind of help them get to the other side and see that there's a different way?
We do. We do a lot of work up front through our content and our webinars, and then, frankly, through our sales process. We spend most of our time trying to convince people that they can't get there with flips and rentals. And then we show them the path forward with apartments, despite these two limitations, in the way we just described. So it's a lot of education. So our sales process isn't really a sales process. It's more like an education process. Mm-hmm. And what I find is when we introduce them to the scaling mindset, the who, not how, it starts shifting things in people's minds, because like Rich Dad, Poor Dad introduces a whole new set of ideas to their thinking that they had never thought about before, right? If you knew you had access to a team of professionals, if you knew you had access to a potential partner who could raise money for you, if you knew all those things, it changes everything. And so showing them and helping them visualize that path forward is eye-opening for people, because in the beginning, it's a false belief, right? Which is then a limiting belief. But a lot of people, it's also a black box, right? So even if you say, yes, you can do that, you're like, well, but I can't, I don't know how. Now, I mean, at one point, I started asking how questions. How is this really possible? Like, what makes this possible? And so painting a picture, opening up the box a little bit and showing them the mechanics of actually going about getting into the business. And I'm a former software engineer, so it's a very step-by-step process. We call it a dealmaker blueprint. Is helpful because now they know, for example, well, what should they do in the first week, the second week, the third week, the first 30 days, the second 60 days, 90 days, what happens after that? It's helpful. So it's this combination of things of of addressing limiting / false beliefs first, and then showing them the process, right? Because they want to know, okay, well, this is cool. I get it. But then what is the actual process? And so once they see that, some people kind of go, this is amazing. I'm going to move forward with that so that I can get into this deal. And the cool thing about it is because these deals are larger and because of the acquisition fees, a lot of students are able to quit their jobs within 1 or maybe 2 deals, which makes it really faster than any other biz op out there, frankly. There's really nothing I know of that allows someone to exit whatever they're doing within 1 to 2 years.
That's really an incredible path, kind of getting people all the way from you were coming in as a single, you're going to buy a single family, right? Or whatever it was, all the way to going out and partnering with others and buying a large apartment building and putting a team together. I mean, in a pretty expedited period of time. I'm curious, as you have taught hundreds, probably thousands of students at this point, right? Are there qualities that stick out in folks? Are there things where you say, wow, that person is going to be successful. This person, we're going to help them along. They may not make it. Like, are there things that you see? Are there common threads across this large group of students?
Yeah, I do. And interestingly, it has nothing to do with demographics or psychographics or anything like that. It doesn't even have anything to do with necessarily resources, though having resources is helpful in some ways, but it's not a requirement. Honestly, the thing that they share is consistency. And I kind of call it, I don't really love massive action. What I really like is tiny action, taking a little bit of action every single day. So we actually have this guarantee in our coaching program that if you don't do a deal in a prescribed time frame, we'll continue working with you until you do. And so people ask, well, what's the success rate? Well, because of the guarantee, it's 100%. Now, the reason that not 100% of our students actually don't do a deal is because they stop showing up. And it's incredibly frustrating. And we actually have mechanisms to engage them, hold them accountable. In fact, we do that. But really what happens is people stop working the system. And it's not a complicated system. At the end of the day, once you learn a bunch of stuff, you pick your mark, you get your team in place, it really comes down to 2 things. It's deal flow and capital. If you're a deal finder, you're really just looking for deal flow. It's super, same thing. Find deals, analyze and make offers, right? If you're more of a capital raiser, you're meeting with investors. It's incredibly simple, okay? And so what people do is they sometimes simply stop showing up. They don't do the work. And it's for a number of reasons. It's a number, they're on a vacation, right? They went on a vacation. Some accept a promotion at work. Well, I'm confused. You just told me you wanted to quit your job, and now you're working 60 hours a week. Now you're managing 100 people, and you're traveling 3 out of 4 weeks. How is that a step closer to financial freedom, right? And so it's really consistency. And the people who are successful, they're not always the smartest. They're not the richest. It doesn't matter what skin color they are. Okay, none of that. But what they do is they keep showing up. They keep working the system, and they just keep moving forward and keep moving forward and keep moving forward and keep moving forward, and they keep showing up. And then it's like what Hal Elrod talks about in his book, The Miracle Equation. I love this because it redefines goal setting. The goal is not, I'm going to do a deal in 1 year. The goal is, I'm going to do a deal. And I'm going to commit to the activities that lead to that outcome for as long as it takes. Now, yes, would I like that outcome to be in 6 to 12 months? Yes, I would. But who cares? What if it takes 6 months? Good for you. What if it takes 18 months? Who cares? Just commit to the activities and keep doing that, because we know that people who continue analyzing deals and making offers are going to get a deal. People who meet with investors are going to start getting soft commits, and they're going to start raising money. It's just that simple. But a lot of people, they stop showing up, and it's for a variety of reasons. I think fundamentally, let me boil it down. I think it's a combination of not being clear about what they want and comfort, which again is going back. They're not really clear what they want, and this is the biggest problem with high income earners. These are the high income earners I observe are the people who most likely want to scale with real estate because they have such a high expenses, right? They need $10,000 to $20,000 per month, and they're not going to get there with a rental. The problem with them is they're comfortable. They're already making good money. They have a nice house, nice family, nice car, right? Why throw it all away for some thing like financial freedom? Now I got to work on this thing, and I got to work over months to get it, right? So it's really people who are able to position their plan A, which is status quo, as unacceptable. They do not see themselves doing the same thing for the next 10, 20, 30 years. They want to work on their own terms. They want to build generational wealth. And the people that want that more than their current life, they keep showing up.
I love that. I mean, there's a lot to unpack there, but I think the idea of consistency just as the most important thing to, or kind of telltale sign of success, right? I mean, I think you hear that over and over again. It has such little to do with where you start and your education, your wealth, all that. It's about showing up every day. And also, so many people I think quit, at the 2-yard line, right? Right before they get there. And so I think the idea of consistency and small little movements, I mean, we talk about in our core values being 1% better every day, right? It's just this idea of just tiny, these small improvements that add up. But I love the idea of keep showing up. And the other thing that you mentioned was this idea of they're too comfortable, right? People that don't succeed are too comfortable. And it's that idea of moving from, away from pain or toward pleasure, right? If you're too comfortable, there's not enough pain there. You're not going to move. You're not going to move. And so you made this comment of the people that really decide, that's a mindset thing, right? That like their status quo is unacceptable are the people that are really going to make that move, into that new space. So I just think some great insights there on what it takes to really become a real estate syndicator as you work through your program. So as we think about switching gears a little bit into actually evaluating deals, right? Because it's the other thing. You've seen thousands of deals from probably thousands of different, probably tens of thousands of deals, hundreds of thousands from different students. And you've helped folks acquire a lot of real estate. But, as folks get started, because I think this even relates to a lot of our listeners who are just passive investors, but they just want to understand that they're making good investments. Can you boil down for us, like, what are some of the key things you help people focus on as they're evaluating deals? Again, not to get kind of stuck in the weeds, but to be able to continue to take action, like you said, is so important.
Yeah. So if I'm an active investor and I'm evaluating deals, right, I want to look for multiple margins for error in my. I want to see reasonably conservative underwriting. Now, on the one hand, I can be super conservative and I'll never end up doing a deal. Okay. Mm-hmm. So you can't be so conservative and have some students do that to avoid actually having to do a deal. And that's also a problem because when we get into real estate, okay, we're no longer in the risk avoidance business. Otherwise you would never get into real estate. You're now in the risk management business. So you have to, as an entrepreneur, real estate investor, accept a certain reasonable amount of risk. The question is how much risk? And that's different for every single person. But what I want to see is I want to see reasonable underwriting in various different parts, and I want to see a buffer for all those things. And if I add them all together, now I have reasonable underwriting. So, for example, loan proceeds, interest rates, or the progression of interest rates. The big one is cap rate at exit, for example, because a tiny tweak in cap rates can make a gigantic difference in returns. I mean, massive. Things like what is your projected increase in expenses? What is your projected increase in rents? What is your projection for vacancies, for example, right? And so the more conservative you are in these different things, you now, as an active syndicator, you have a better story to tell your investors, right? Because your investors really need to ask you questions around your assumptions. What drives me crazy from an investor perspective is that they shop returns. Well, maybe people don't do that anymore, but in the day, they're like, oh, this deal's got 19% IRR. This got 21% IRR. Well, clearly the 21% IRR is better. Well, here's the thing. I can make my spreadsheet say anything I want. Okay. And that's the truth. And unfortunately, a lot of syndicators did exactly that. And they had these outlandish, incredible returns, which were not based in any kind of reality whatsoever. Investors were dumb enough to wire money because they never actually asked questions. Now, the passive investor doesn't have to be an expert. Okay. They don't have to be an expert at all. They just have to ask some questions, at least some questions, right? So questions around, well, why do you think that cap rate is reasonable? Well, okay, what's the cap rate right now? Are cap rates going up or down? Does that story is in line with interest rates, right? Are the interest rates going up or down? Okay, well, if interest rates are going down a lot, is that in line with projections? I don't know. Flat? Okay, reasonably up. Well, it gets very conservative, right? What about occupancy? All right. So, 10% occupancy in year one, and then it goes to 8, and then it goes to 6 sounds reasonable, but you're doing a value add deal where you're turning over, 15% every single month. Well, wouldn't your occupancy actually go up if you throw a bunch of tenants out? And wouldn't your occupancy actually go greater than 10%? And the answer is yes, most likely, because you're doing a value add. Your first year, if you're trailing 12 is 10%, it's probably not going to stay 10%. Okay, it's probably going to go up to like 20% for the first 2 years. Stuff like that. Okay, stuff like that. Or I have 12-year debt. Cool, fixed interest, love that. But we're selling in 5 years. Okay, cool. Did you put in a prepayment penalty or yield maintenance in your underwriting? Yes, cool. No, what is that? That's a problem, right? Or I can go on. Reserves. Do you have a certain amount of reserves when you close? And do you have a cash buffer when you close for unforeseens? Are you replenishing those reserves out of cash flow? Because if you're not, guess what? Your NOI is going to be higher. Therefore, your returns are higher. But now I'm depleting my reserves over time. So that's bad. These are some questions for the passives to look for, and also for the actives to make sure that they address in their underwriting.
Yeah, and you just threw a whole bunch of questions out there. I don't know if I caught all of them, but I'm going to go back and listen to them, as you guys should, because there's a ton of gold there. Honestly, it is all about just it's testing the assumptions, right? That's what it's all about. All of these spreadsheets. I love what you said. You're like, I can make my spreadsheet say whatever I want. Absolutely right. Right. So it's all about the assumptions underlying what the numbers are. And you mentioned a ton of great things, from the debt to the cap rate, right, to understanding rent, expense growth, and everything in between, on what people should be asking to understand in every situation. Is the assumption reasonable, and did they do their homework? Like, what's behind the assumption? Yeah, that was perfect. So, something else you mentioned was that there's just, this idea of, it's called analysis paralysis, or this idea of being overly conservative to just never do a deal right and have to take that step. That's something that I've experienced in my career, for sure, being worried about taking that leap at the beginning. I know a lot of others that have. It's a big hurdle for folks, right, to take that first step. So how do you, as you're coaching people through, whether folks are active or whether folks are passive, and they, eventually, no matter what, you got to take the leap. You got to make the investment in some way or another. How do you help people kind of get over that mindset?
Yeah, you got to be an action taker, right? And so, how do you determine whether you're an action taker? And so I look at past behavior. For example, if you've bought a rental or done a flip, you're an action taker. Okay. If you've never done that, well, I don't know yet. I don't know if you're an action taker or not, right? If you sign up for a coaching program and you pay a bunch of money, well, you appear to be an action taker, and so that's a plus. But it's not a guarantee that you're an action taker, right? And so you kind of learn every single student as you go along. There's a spectrum of people who are just complete action takers. They don't think about anything. They're like, blah, I'm just going to do it, right? And then you have the paralysis analysis people who feel like they need to have all the answers, everything lined up before they take action. Now, they're both problems, but if I had to choose one of them, the bumbling idiot who takes action is going to be more successful all the time, every single time, because the analysis paralysis person is never going to take action. And the reason they don't take action is because they're afraid to make a mistake. And in their mind, they think that the way to protect themselves is to have everything lined up. But here's the thing. As an entrepreneur, okay, there are no guarantees. Actually, no guarantees in life at all, in general. But a lot of people, especially if they're engineers, right? We find a lot of engineers are very analytical, or the architects, obviously, or whatever. And or the surgeons, right? That's very important in certain jobs, that you've got to have everything lined up. Otherwise, people die. Buildings collapse, right? Whatever. So it's very, very important. But in entrepreneurship, that does not serve you, okay? It doesn't serve you because you have to learn how to deal with a certain degree of uncertainty. Now, I'm not a speculator, okay? I am an educated risk taker. I work in probabilities, right? So if I were to play poker, which I don't, right, I would probably stack the probabilities in my favor, and I would fold when the probabilities are against me, and I would hold when the probabilities are for me. And as an entrepreneur, it's very similar. I'm always looking for probabilities. I'm looking for taking educated guesses. But they are calculated risks I'm taking that are in my favor. Now, sometimes they don't work out, but most of the time, hopefully, they do work out. And so the person who wants to get into real estate investing specifically has to be able to learn to deal with a certain degree of uncertainty. They're not going to have all the answers up front. They're not going to have a 100% plan from where they are to closing a deal. There's too many variables, and it's going to be freaking overwhelming, right? If I show you all the steps you need to take, and they go, you know what, it's for the birds. I'm not even going to do that. What we teach is just do the next three things. It's simple because everyone knows the next three things. Think of any goal in life. Okay, you want that thing, cool. Well, what are the next three things you think you should do? Well, I should probably do this and do that and do this. Okay, write that down. Do those three things. It should last a week or two. Do those things. Cool. Cross them off. Write down the next three things. And so that starts building some momentum with some people who are typically more paralysis analysis. It builds up momentum. And I think the more a small activity they take, the more momentum they'll build up to basically developing consistency, which is what we talked about earlier.
I love that framework of just breaking it down into small steps, like as small of the steps as you can. I mean, this works for anything in life, right? Break it down into small steps and then just start taking action. And then you will build momentum, right? And you will realize, oh, I did that. Oh, I did that. Oh, I did that. What's next? Oh, I did that. And I think it works with any goal. I've definitely used that process before when there's things that I just don't want to go after, right? It's okay. Well, I can do this. I can do that, and then, okay, you're on your way, right? And, object in motion stays in motion, as they say. So super valuable tip again, Michael. I think last thing I want to ask you as we get to the end of the show is your perspective on more the market, where things, not as much where things are going, but how do you tell your students to really think about the market right now? Because it's much different than 3 years ago or 5 years ago or almost 10 years ago when you first started, right? So how are you telling people to look at it right now?
Yeah, I mean, first of all, the market is always changing. So my students are always taught to adapt, whatever it is. And how do you know that you're adapting? Because you're working with your professional team, you're working with a mentor who have a lot of industry experience, is to adapt. You're always adapting your underwriting based on what's going on, number one. So trying to time the market is, I think, a mistake as long as the asset class is sound. So what I mean by that is multifamily sound over the years, the decades, and the answer is yes. It's performed very well in 2008. It surprised us in COVID. It was amazing as inflation raged, right? So if you look at all of the recessions and market twists and turns, multifamily actually performed fairly well. That can't be said for other asset classes like single-family houses. It got clobbered in 2008. Retail got clobbered in 2008. COVID crushed office to some degree, retail as well. And so is the asset class sound through various cycles? Yes. Okay, cool. Now, if that's the case, then yes, I need to adapt my approach. So number one, adapt the approach. Number two, though, from a market timing perspective, because people do ask, we are in a completely different spot than where we were 2.5 years ago. There's always this thing called risk-adjusted return, which we should talk about from a passive investment standpoint, is you don't just shop the return, you also go look at the risk, right? And so 2.5 years ago, while the returns were fantastic, the risks were also on the high end of the spectrum of multifamily. Multifamily being in the lower end of the risk spectrum in general of real estate, but within that multifamily spectrum, it was on the higher end of the risk. Why is that? That's because leverage was the highest you can ever get at the time, right? Interest rates, historic low, essentially zero. The only place you could go was up, right? Leverage is very high. Interest rate is projected to go up. And so obviously from a risk spectrum, that is higher risk for both of those reasons. Now, 2.5 years later, it's quite a bit different. Interest rates are very high, which isn't the problem in itself. It's the projected trend of that interest rate, which is flat to down. That's markedly different than up 2.5 years ago. Also, the leverage we're getting is vastly lower than it was 2.5 years ago. It's much lower. And of course, it's very, very fixed now to some degree, whether you're using long-term interest rate caps or actually fixed debt. It's very rare that you see someone going, I'm going to get myself a 1-year bridge loan. Like, it's not happening anymore. Right? So the risk spectrum, the risk-adjusted return in multifamily is much, much, much lower than it was 2.5 years ago. So the risk profile is different. Number two, though, the outlook is different than 2.5 years ago. The outlook is much more positive. While no one could forecast that it was going to get so bad, okay, so quickly, no one could foretell that. The outlook was still interest rates are going up. We don't know how high and how long, but interest rates going up. Obviously, that's negative for real estate. Everybody knew that. But now the interest rates are flat to down. That's somewhat positive. Also, the thing that was negative about 2.5 years ago was all the free COVID money. So people were pulling permits left and right. So it was foreseeable that there was going to be a lot of new supply coming on the market, which it did towards the latter part of 24 and into 25. that is now being absorbed because there's nothing behind it. If you look at the permits that have been pulled over the last 12 months, they've plummeted because developers can't make money anymore. Okay, unless you're doing your public-private stuff that you're doing, which is super cool. The average developer, not on Moss, they're not really pulling permits anymore, so there's nothing behind it. Once this is absorbed, which is projected to happen this quarter in Q4, there's nothing behind it. So the Class A, that's been encroaching on Class B and C to some extent in rents to fill things up, they're going to start moving up. And that gap between Class A and Class B is going to come up again. And that's going to lift everything. All that absorption is going to lift Class B and Class C because there's no more Class B being built. You can't build it. It's too daggone expensive. So the thing, you have a growing population chasing a finite housing stock. What's that going to do to the rents? For the average person, that means the rents are going up. If you're holding rental property, that's good for us. Is it good for the average American? No. Do we still have a massive housing crisis? Yes, that's got to be solved. But in the meantime, owners of rental property are going to profit from that.
Yeah, I mean, that was really well said, right? And I love that you mentioned risk-adjusted return. That's one of my most near and dear metrics to understand and look at. And you really hit the risk side, which I really appreciate because oftentimes we like to focus on the return and the shiny object. But I love what you said, that risk is, really off now from compared to where it was, right? When you think about, and you mentioned debt, which I think is often left behind, but the biggest part of the capital stack, right? But leverage is down. Cap rates have expanded, prices are down. Relatively speaking, you're right. To several years ago, there is a lot more risk built into deals today. When you think about, what really adds risk and what can really make things go wrong. And then into the foreseeable future, as you said, right? Supply, keeping an eye on supply, but supply really down because people aren't building. Right? We know there's a major housing shortage. We know we can't catch up because of regulations and costs and other reasons. And so we know that just like Econ 101, right? Supply and demand. What happens? Well, when supply is down, and there's strong demand, prices are going to increase in any market. So, we expect to see that as well. So I think really, really well laid out, Michael. Appreciate your perspective on where you think things are going. And as we wrap things up on the show, I want to take you through our keys to success round. It's the same 4 questions I ask everybody. First question is, if you were a passive investor, right? Maybe you're going to invest alongside with one of your students, and you didn't know anything about the deal. You could only ask one question. What is the one question that you would ask?
I'd like to know a time where something went bad, where you faced some kind of challenge or setback or default or foreclosure or something like that. I'd like to know that. And I'd like to know, related to that, what happened and what was the result of that.
Yeah, I think you get to so many things through asking that question, right? And right. Are they going to? Is there accountability? Are they action takers? Are they problem solvers? Right? I think that's
learn a lot about a person. Yeah.
Learn a lot about a person by the losses. I completely agree. And if they don't have any, then that might be a question too, because I think you and I know anybody that's done this long enough, there's going to be something.
I agree. Hasn't done long enough. And here's the thing: people, the first time they go through a really hard time, it's going to be very stressful for them, right? And so I don't want to be their guinea pig, helping navigate their first major challenge in their investment career. So, So I like someone who's been through the ringer before. That will make me feel better.
Very well said, Michael. What are you most proud of in your career?
Well, shoot, I don't know, so many different things, but I am proud of the educational company that we built and really helping people do something that they couldn't do before, which is actually scale with real estate by buying a multi-million-dollar apartment building, which they probably didn't think was possible before, and then quit their job, and then some of them actually become mentors for us as well, which is really cool. So I think we've built an incredible system to attract and then actually educate people and give them a mechanism to do this with a high degree of success. So I think I'm proud of what the team has built here over the years.
I think it sounds like there's a lot to be proud of there. Absolutely. What is the book that everybody should read?
You mean besides my own? Nothing.
Besides
really.
your own, you can chill it.
Besides my own, I did mention Hal Elrod's book. It's called The Miracle Equation. He's mostly known for The Miracle Morning, which is a required read as well. But his Miracle Equation, I think, is good, especially when you're trying to do meaningful things transformational things for the reasons we talked about. So I would recommend that everybody check that book out as well.
That's awesome. And last question, what is your number one key to success?
Clarity. Developing clarity. And that requires, yes, a morning routine. But you really need clarity in many different things. A lot of people are so busy, they kind of just drift through life. I probably drifted through life until my mid-30s or so, until I started to become more intentional. And I think most people just in general are not intentional. Everything flows from clarity, and everything with a lack of clarity is befuddled, and it's not going to work because you're not actually clear about what you want. So I think spending time to become clear what you want is absolutely key, and most people don't take the time to do it.
Man, yeah, I mean, that's powerful, right? I mean, just how do you get clarity when you're super busy, right? Running around all the time. I mean, you got to start with that. But I think the ability to gain insight into where you're going, right, and go after the things that really matter, not just whatever comes at you day to day, right? I think super powerful. So, Michael, thank you so much for being on the show today and sharing all your wisdom. If folks want to learn about what you're doing and your programs, how can they reach you?
Yeah, the best place to reach me is thefreedompodcast.com/Kent. Thefreedompodcast.com/Kent. It's just a launch pad for our podcast. A lot of people listen to our podcast, but we also have some resources about learning more about scaling with real estate. So we actually have we call it the scaling course, the Empire Builders Playbook, which talks about how to actually go from single family house investing to building a multifamily portfolio. That's on thefreedompodcast.com as well. And then people can also learn about investing passively in real estate syndications if they've never done that before. So the best place to go is thefreedompodcast.com/Kent.
Awesome. Appreciate that, Michael. Made it easy for everybody. We'll link all that down below, guys, so you can go check out Michael's content. And with that, Michael, hope you have a great rest of the day.